67 million ounces. That's the hole in the global silver supply this year, and it's still there even after the bombs stopped falling. 3 days ago, the United States and Iran signed a deal in Islamabad to end a war that started on February 28th, a war that opened with the assassination of Iran's supreme leader and ended with mediators racing to get both presidents to sign before something else went wrong. Stocks jumped, oil dropped, everybody exhaled, and then gold barely moved and silver gave back almost everything it had just gained in less than 24 hours. If peace was supposed to fix this market, why didn't it? This is John A.G. Finance, and if this kind of breakdown is useful to you, hit like and subscribe, because what I'm about to show you is the part almost nobody is explaining correctly right now. Most channels are telling you the war is over, the danger is gone, buy the dip. I'm going to show you why that's only half true, and why the second half of this story is actually more important than the war was in the first place. Let's set the scene properly, because the timeline matters. On February 28th of this year, the United States and Israel launched joint strikes on Iran. The opening strike killed Iran's supreme leader. Iran responded with a wave of missiles and drones across the region. For months, the fighting spread into Lebanon, rattled Gulf states, and choked off the Strait of Hormuz, one of the most important oil choke points on the planet. Oil spiked above $100 a barrel. Every rate cut the market had been pricing in for this year got erased overnight. That's the part people forget. This wasn't just a regional war, it was a direct hit on global inflation expectations, and inflation expectations are the single biggest lever that moves gold and silver. Then, on June 14th, mediators announced a memorandum of understanding. Pakistan brokered it. On June 17th, Presidents Trump and Pezeshkian signed it electronically. The deal commits Iran to staying away from nuclear weapons, formally ends the fighting, and reopens the Strait of Hormuz with 60 days to finalize the details. Markets reacted instantly. Silver jumped almost 3% in a single session. Gold gained 2%. For about a day, it looked like the textbook story was playing out exactly the way it's supposed to. War ends, fear drops, safe havens cool off, risk assets rally. But here's where it gets interesting, and here's where you need to slow down and actually pay attention, because this is the piece almost every other channel is skipping. The day after the deal was signed, silver opened down nearly 4%. It fell from over $70 an ounce to under $68. Gold barely budged at all. If the war was really the main thing holding this market hostage, peace should have sent both metals soaring. Instead, the metals shrugged. So what's actually driving this market if it isn't the war anymore? The answer showed up the very same week, and it's sitting right next to the peace deal in the headlines, almost like the market is trying to tell you something. May's inflation report came in at 4.2% year over year, sitting above both the Federal Reserve's target range and above the yield on 2-year treasuries. Core inflation came in at 2.9%. That's still elevated, even with the war fading into the rearview mirror. And on June 17th, the same week the peace deal was signed, the Federal Reserve held interest rates steady, but the dot plot, the chart that shows what each Fed official expects rates to do, came back split almost down the middle, with several officials still pushing for more hikes, not cuts. The dollar surged to its highest level in over a year. That's the headwind nobody's talking about, and it's a bigger one than the war ever was. Here's what nobody is asking. If the geopolitical risk premium is leaving this market, what's left holding the floor underneath gold and silver? Because something is. Gold is still trading well above where it was a year ago. Silver, even after this pullback, is still up well over 100% year over year. That kind of move doesn't happen because of one war in one region. It happens because of something structural, something that doesn't go away just because two presidents shake hands. So let's pull that thread, because this is where the surface explanation completely stops working. The first structural force is debt. The United States is carrying more than $37 trillion in national debt, with annual interest payments now exceeding $1 trillion a year. That's not a war number, that's a permanent number. It doesn't reset when a ceasefire gets signed. The second force is central banks. The World Gold Council just reported that a record 45% of central banks around the world plan to add gold to their reserves this year, not because of Iran, because of a much longer, quieter shift away from relying entirely on the dollar as the world's reserve asset. That trend started years before this war, and it will keep running long after this war is forgotten. Now, layer in silver specifically because silver doesn't move like gold, and that's the mistake a lot of new investors make. Gold is mostly a monetary asset, a store of value, something central banks and big funds hold as insurance. Silver is half monetary asset and half industrial metal. It goes into solar panels, electronics, electric vehicles, military hardware. And the Silver Institute is forecasting a supply deficit of roughly 67 million ounces this year. That means the world is consuming more silver than miners are pulling out of the ground for yet another consecutive year. That deficit doesn't care about ceasefires either. It's a mining and demand problem, and those take years, not weeks, to fix. This is where the story changes. Watch the ratio between gold and silver prices, because it's been quietly sending a signal underneath all the war headlines. That ratio measures how many ounces of silver it takes to buy 1 ounce of gold. A few weeks ago, it was sitting around 64. It's been sliding down toward the low 60s since. A drop like that, several points in 2 weeks, is not random noise. It means silver has been outperforming gold beneath the surface, even during a stretch where the headlines were all about war and peace. That's the kind of signal that tends to matter more than any single news cycle, because it reflects what large pools of capital are actually doing with their money, not what they're saying in interviews. And there's another wrinkle most coverage glossed right over. A few weeks before this ceasefire, Iran briefly reopened the Strait of Hormuz, and oil actually crashed more than 10% on that news. You'd expect gold to crash with it, since oil and inflation fear usually move together. Instead, gold went up. Oil down, gold up, same trigger event. That divergence is a tell. It means the rally in gold wasn't really being driven by war fear in the first place. It was being driven by monetary forces underneath it, the debt, the dollar, the central bank buying, and the war was just adding a temporary spike on top of a trend that was already running. Once you see that divergence, you start understanding why peace alone was never going to be enough to cool this market down. Now think about who's actually buying. It isn't retail traders chasing headlines. The World Gold Council's reporting on central bank demand reflects finance ministries and reserve managers making multi-year decisions, the kind of buyers who don't reverse course because of a single signing ceremony in Islamabad. When you've got nearly half the central banks on earth telling surveys they intend to keep adding gold, that's not sentiment. That's policy. And policy moves slower than headlines, which is exactly why gold barely flinched on the peace deal while stocks went vertical. Stocks react to headlines. Gold increasingly is reacting to balance sheets. Then there's the Fed itself. And this is worth sitting with for a second because it's genuinely unusual. Kevin Warsh, brand new at the chair, skipped the traditional forward guidance entirely at his first meeting and didn't walk the market through a dot plot the way Powell always did. That's the biggest shift in how the Fed communicates in close to 2 decades. Less forward guidance means more uncertainty about where rates go next, and markets that are uncertain about rates tend to lean on gold as the asset that doesn't depend on anyone's promise about the future. So even as the war fades, you've got a brand new source of uncertainty stepping directly into the vacuum it left behind. Put all of that together, and you start to see the real shape of this market. It was never just one story. It was war fear, layered on top of inflation fear, layered on top of a debt problem that isn't going anywhere, layered on top of a central bank buying spree that started years ago, layered on top of a silver market that physically cannot produce enough metal to meet demand. Pull one layer away, the war, and the other 4 are still standing right where they were. That's the system view. That's what most people watching the headlines this week are completely missing. Let's zoom out to the full system for a second, because all of these pieces connect. You've got a war that just ended, which removes one source of fear, but does nothing to fix the debt or the deficit. You've got a Federal Reserve that's internally split, with a brand new chair in Kevin Warsh, who scrapped the traditional forward guidance entirely at his first meeting, which means the market has less certainty about future rate moves, not more. You've got inflation that's cooling month over month but still sitting above target. You've got a record share of central banks accumulating gold for reasons that have nothing to do with the Middle East. And you've got a silver market that's structurally short on supply no matter what happens geopolitically. Every one of these forces points the same direction over time, even while short-term price action whips back and forth on headlines. So what happens from here? Let's walk through this without overcomplicating it. In the base case, the ceasefire holds through its 60-day window. Oil stays calm, inflation keeps cooling slowly month over month the way it did in May, and gold and silver spend a few weeks consolidating, chopping sideways before the structural forces, the debt, the central bank buying, the supply deficit, reassert themselves and pull prices higher into the back half of the year. That's the scenario most analysts at the major banks are leaning toward right now, treating this pullback as a buying opportunity rather than the start of something worse. In the risk case, the peace deal is shakier than it looks on paper. Remember, this region has already produced more than one ceasefire this year that fell apart within days, sometimes within hours, after both sides initially claimed it was holding. There's still a 60-day window before this agreement is even fully finalized, and a lot can go wrong inside 60 days. If fighting flares up again, even briefly, even just a handful of strikes, you'll likely see a sharp, fast spike back into both metals as the war premium snaps right back into the price, the same way it did within minutes the first time shots were fired back in February. And in the extreme case, inflation doesn't cool the way the Fed is hoping it will. The next CPI print comes in hot instead of soft, the dot plot turns more hawkish at the following meeting instead of less, and you get a genuine collision between two powerful forces pulling in opposite directions, a strong dollar and higher real rates pushing metals down on one side, while a deteriorating debt picture and a falling dollar over the long run pushes them up on the other. That's the scenario where volatility gets the wildest, where you see silver swing 5 or 6% in a single session the way it already has twice this year, and where the difference between paper positions and physical holdings starts to matter most for anyone actually trying to protect their money rather than just trade a headline. If you've made it this far, you already understand something most casual investors don't. The headline that says the war is over is true, and it matters. But it was never the whole engine driving this market in the first place. The war was the loud part, the debt, the central bank buying, the silver deficit. Those are the quiet part, and the quiet part doesn't go away when a deal gets signed in Islamabad. Drop a comment and tell me whether you think the Fed or the supply deficit ends up mattering more by the end of this year. I want to see what you're watching. And if this helped you see the bigger picture, share it with someone who's still thinking this market is only about Iran. Wars end. Ceasefires get signed, sometimes they even hold. But debt doesn't get a ceasefire, and a supply deficit doesn't sign a memorandum of understanding. The fighting in the Middle East may be winding down for now, but the forces that pushed gold and silver to where they are today were never really about the war at all. And that's exactly why this market still isn't safe to ignore.